This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
A new offensive. The president vows to fix the problems that have plagued the rollout of his landmark health care law. But can it be fixed fast enough? And do the insurers have more at risk than once thought?
Record penalty. J.P. Morgan reaches a tentative $13 billion deal to settle allegations related to the financial crisis. But what about criminal charges? And will the government go after other banks next?
Deep in the heart of Texas, a small town is quickly becoming one of the largest oil and gas producing areas in the world. But could the energy boom end in a bust? All that and more tonight on Nightly Business Report for Monday, October 21st.
Good evening, everyone. President Obama saying today it's going to get fixed. He spoke out for the first time about the botched rollout of his administration's online health insurance exchanges that started 3 weeks ago. Surrounding himself at the White House with people who have successfully signed up for the new health care plans, the president vowed to get the glitches repaired. It's a big fixer-upper. Thousands of Americans are still unable to sign up for a new insurance plan because of lost information, long waits, and error messages. So can the problems be fixed, and will enough Americans be able to sign up for the new plans? Bertha Coombs joins us now with more. So, Bertha, first time that the president's saying this is a mess.
Really, it is. It's a very big shift in tone from what we've heard the last couple of weeks. President Obama defended his signature health plan in the Rose Garden today, saying almost 20 million people have logged on to healthcare.gov. Hundreds of thousands have been able to register to try to shop for their insurance. But for the first time, he called the troubled launch unacceptable and said the administration is ramping up its efforts to get it fixed.
President Obama leading a new offensive from the White House, trying to assure Americans his administration is focused on fixing the technology problems that have plagued the federal health insurance website, healthcare.gov.
There's no sugarcoating it. The website has been too slow. People have been getting stuck during the application process. And I think it's fair to say that nobody's more frustrated by that than I am, precisely because the product is good.
The president said a team of experts has been called in to lead a so-called tech surge to speed up a fix, and that he is now demanding action.
Nobody's madder than me about the fact that the website isn't working as well as it should, which means it's going to get fixed.
While the administration says the team includes outside tech experts, it did not offer any names or a timetable for a fix.
One of the problems with the Obama administration launching this has been their lack of transparency. So we don't know exactly how bad it is. We don't know how long it's going to take to fix.
One former government technology contractor says it could take time for the tech surge team to pinpoint a solution.
The government's probably been given some initial answers by the contractors, and those, having lived through some of these situations, those are probably hypotheses. And as they go through and test those hypotheses, some are proving right, and they're getting some issues resolved on the site, and some are proving wrong. And the question now is, how wrong are they? What else is there to learn?
And how quickly can they fix it? Another concession of sorts this afternoon, Health and Human Services Secretary Kathleen Sebelius may be headed to Capitol Hill after originally saying she would not be able to testify before the House at a hearing on Thursday due to scheduling conflicts. Her staff now says they are working on a mutually agreeable time for her to appear.
So you talk a lot about these tech experts coming in, but they don't know how fast they can do it. They don't know, what the deadline's going to be. Now, there is this March 31st deadline that you have to be signed up or you get penalized, and that could come up very soon. So
it's actually before that. If we actually talk about the timeline, if you want to be covered by January 1st, you need to sign up by early December. So a lot of folks who have been looking at this say they really need to get these problems in order to get online enrollment rolling quickly. They have to be fixed by around Thanksgiving time to really be able to handle that surge. And you will actually be penalized, although this will likely get pushed back, but you actually need to sign up to allow time for your your plan to be in effect by sometime in mid-February, actually, or you get penalized because if you're not covered for 3 consecutive months, that's when you have to pay a penalty for every one of those months you're not covered.
I tried to sign up again today. I got farther. I, quote, enrolled, but I could not go and shop for plans. I'm going to keep trying here. The president eloquently expressed his frustration, even his anger. He did not express an apology, however, to people who are similarly angry to him, as he is. And no one has paid with their job yet. Will Secretary Sebelius be forced to resign?
That's the $2.7 trillion question, how much we spend on health care. And there are certainly people, even on the Obama team, who are saying that somebody needs to be held accountable. Robert Gibbs among them. Somebody needs to lose their job over this.
Bertha Coombs, thanks very much. I'll let you know if I get to sign on and shop. While the troubled websites that let you pick insurance are run by the government, the coverage itself is sold by private insurers. The stocks of many of those companies have been rising on the prospect of potentially millions of new and profitable customers. But if people can't sign up, or if only the sickest do, the profit and loss assumptions may be seriously flawed. Joining us now to discuss is A.J. Rice. He's healthcare facilities analyst at UBS. A.J., welcome. What do the insurers fear the most, and who is most at risk among the insurers that are participating?
Yeah, so I think what they do fear is exactly what you're talking about, that this ends up being a program where the people that have a lot of pre-existing conditions that haven't been able to get insurance sign up, and those that are healthy, relatively speaking, stay on the sidelines, and you don't have a balanced pool. The people that are the leaders in putting these plans out there right now tend to be the Blue Cross plans. Many of those are quasi-nonprofit, but WellPoint, among the publicly traded companies, is one of the leaders on the exchange. In the 14 markets where they have a Blue Cross banner, they're out there aggressively offering product because historically the individual market and the small group market have been their strength, and that's the type of person that's ending up on these exchanges.
So, AJ, if people get so frustrated they just give up and don't sign up, what's at stake besides for the insurers, for the hospitals, and also for consumers who are part of the program and may be stuck with higher prices possibly? I mean, what's at stake here?
Yes, so, you know, from an investment perspective, we actually are a little more favorable toward hospitals across the board because they've been the safety net for the last 25 years since the Medicare programs were implemented. They take on the uninsured and do not get compensated. Even if we just get the relatively sick people with pre-existing conditions signing up, those are the ones that have historically shown up at the hospital and not had the ability to pay. So an HCA, a Universal Health Services, we think that's a little bit more of a cautious way to play this. We do believe that for the insurers, it's going to be tough until we get clarity as to whether they'll be able to fix these glitches and whether people will be able to sign up sort of in the time frame you said. We think they need to have it pretty much fixed by mid-November because that's when the bulk of the signups will probably come between then and year end.
I guess one of the real selling points of the Affordable Care Act was that it was going to make coverage available to the very people that you're talking about, those with pre-existing conditions. One of the things that has stood out to me is how few companies relatively are competing in some states like Connecticut, whereas I understand that there are only 3 plans to choose from on that state's exchange, home of Aetna. And number 2, why some of the biggest companies in healthcare insurance, like Aetna, like United Health, like Cigna, seem to be tiptoeing in here very timidly. Why?
Right, that's exactly what they're afraid of. They're afraid that we're going to see a great divergence in the types of people signing up and that the underwriting risk associated with those pools could be difficult. So they've chosen to focus on the markets where they have very strong presence, a lot of leverage to drive price concessions with hospitals and doctors. And so you're seeing those companies, which happen to be the ones we're recommending, be much more selective as to where they're going and what exchanges they're participating on. So I think, again, that's sort of a cautious way to play this.
All right, AJ, thank you very much for being with us and helping us out there. AJ Rice is healthcare facilities analyst at UBS.
Thanks.
On Wall Street today, it wasn't much, but it was just enough to chalk up another record-breaking session for the S&P 500. The major indexes were little changed after a mix of third-quarter earnings reports and disappointing housing data. We'll have more on that a little later in the program. The Dow lost 7 points, the Nasdaq rose 5, the S&P edged up a fraction.
The nation's biggest bank, J.P. Morgan Chase, has tentatively agreed to a $13 billion settlement with the U.S. government for misleading investors and mortgage agencies about the safety of mortgage-backed securities it sold ahead of the financial crisis. That would be the largest fine ever paid by a single bank to settle civil charges, yet doesn't even resolve a possible criminal case. Kate Kelly has more on the proposed settlement, what it means for J.P. Morgan and CEO Jamie Dimon and other banks.
The landmark $13 billion settlement that J.P. Morgan is hammering out would resolve a good deal of the outstanding legal issues around past mortgage securities that have been weighing on the bank. Among other things, it would seal off probes by the Justice Department and New York State and perhaps create some goodwill with taxpayers by establishing a multi-billion-dollar fund for consumer relief. It could also set an unnervingly high bar for other banks. Bank of America, which has already paid tens of billions of dollars to settle an array of mortgage investigations in recent years, is also under a probe by the DOJ and has not yet settled. Citigroup, which recently settled with Fannie Mae and Freddie Mac over questionable mortgages, albeit for lower sums than what B of A paid, is also still under a cloud. In an interview outside his office today, J.P. Morgan chief Jamie Dimon said he's working to put the mortgage litigation behind him.
My real confidence this morning, you've been staying home more. Our people coming in bright-eyed and bushy-tailed.
And they're not happy to see us.
260,000 people around the world doing a great job for our clients. Okay, we're gaining market share, we're doing great stuff, we're trying to get our problems behind us.
But in the end, even the $13 billion deal won't wipe J.P. Morgan's slate entirely clean, given that criminal charges could still be forthcoming. For Nightly Business Report, I'm Kate Kelly in New York.
How could the J.P. Morgan fine impact the housing market? Coming up a little later in the program, we'll examine whether the penalty, along with the proposed new mortgage rules, could make it more difficult for home buyers to get a home loan. Meanwhile, where does J.P. Morgan's $13 billion settlement with the Justice Department rank among the biggest corporate fines ever paid? Take a look here. BP was fined $4.5 billion for the 2010 oil spill in the Gulf of Mexico. Bank of America paid $8.5 billion in 2011 for selling risky mortgages that later went bad. J.P. Morgan and 12 other banks agreed to pay the Federal Reserve and others more than $9 billion earlier this year over abusive foreclosure practices. Last year, 5 of the nation's biggest banks, including J.P. Morgan, agreed to pay $25 billion in penalties in a separate abusive foreclosure case. And the biggest ever, the 1998 deal with the 5 biggest tobacco makers, $246 billion over 25 years.
Meantime, the banking industry just released the results of a test on its trading systems in the event of a big cyber attack, an exercise dubbed Quantum Dawn 2, very Hollywood. Wall Street regulators say the results show a resilient market, but one that must remain vigilant against a constant barrage of online attacks aimed to shut down the banking and stock trading systems. Last Friday's 6-hour test included participants from big banks, major stock exchanges, utilities, the U.S. Treasury, the FBI, and others.
Still ahead on the program, the not-so-shiny golden arches. McDonald's posting 4 straight quarters of disappointing earnings, and its outlook isn't much better. What can the company do to turn things around? But first, let's take a look at how the international markets closed today. Not so appetizing profits from McDonald's today. They rose 5% for the latest quarter, with slightly higher sales in the U.S. offsetting a sharp drop in Asia. But those numbers, the 4th straight quarter of disappointing earnings, along with a weak outlook for the current period, sent shares lower today and raising concerns about Mickey D's growth. Dominic Chu has more on what the world's largest burger chain is cooking up to turn things around.
Investors can't be loving it. It's still the undisputed champ when it comes to burgers and fast food, with about 7 times the worldwide sales of Wendy's and Burger King combined. So the problem isn't volume, it's growth. Sales at McDonald's open at least 13 months were up less than 1% in the 3rd quarter, just short of what analysts were expecting.
It is about innovation for McDonald's and trying to find that, home run type product, and so far they just haven't been able to nail it down. Regardless of all the advertising and the new products they're trying to put out, nothing seems to be grabbing the traffic and driving it through the doors.
Globally, sales are dragging. They can't raise prices in Europe, and revenues were down in Japan and in China, where McDonald's has stopped opening new restaurants. Yet in a struggling economy, competitors like Chipotle have been growing. McDonald's has tried coffee, healthier options like salads, and promotions like, of all things, chicken wings. Short term, they've helped to mask shrinking sales of burgers and fries, but many wonder if McDonald's has spread itself too thin.
McDonald's is McDonald's. I don't think if they're offering healthy food, I don't think it's healthy.
Sometimes I buy the healthy stuff like the salads and sometimes the wrap. Not too often, though.
Another byproduct, all those menu options make it tougher to meet the industry standards for fast, as in fast food.
I think their service has been a little bit slower since they added the new items.
I think their service is still pretty good. I don't think every time I come through a drive-thru, their service is pretty quick.
In a little more than a year since he took over, CEO Don Thompson has shaken up the management and the menu. But 4 quarters of disappointing results mean it's only getting hotter in the kitchen. For Nightly Business Report, I'm Dominic Chu.
Netflix soars after the closing bell, and that is where we begin tonight's market focus. Third quarter profit more than quadrupling as the subscription video company added 1.3 million customers in the U.S., the biggest segment of its business. Netflix also issuing a rosy outlook for the current quarter as it continues to focus on developing original content. The stock up 6% in the regular session to $354.99, and it soared. Look at that spike after hours to an all-time high, continuing its run as one of the best-performing stocks so far this year. And VF Corporation, the owner of North Face and Timberland, reported better than expected earnings and maintained its full-year forecast, even as other retailers brace for a tough holiday season. The apparel maker benefited from strong sales of its outdoor and higher-margin action brands and also announced a 4-for-1 stock split. Shares rose more than 3% to $211.23. Strong overseas performance helped boost Hasbro's bottom line. The number 2 U.S. toy maker beat profit and revenue estimates despite weakness in the U.S. It said it plans to roll out new games to increase holiday sales. Hasbro shares up 5% to $49.72.
Halliburton is yet another oil field service provider that beat Wall Street estimates. The company benefiting from strong performance in international markets such as Russia, Saudi Arabia, and Angola. But revenue for the quarter came just shy of expectations, sending the stock down 3.5% to $50.66. A shot in the arm for shares of Radio Shack, the company reportedly securing new financing from GE Capital ahead of the holiday season. The funds will help free up cash and be used to finance the electronic chain's overhaul. The stock popped 7% to $3.52. AT&T is leasing and selling the rights to 9,700 wireless towers to Crown Castle International for almost $5 billion. AT&T's goal is to generate cash so it can upgrade its cell phone network and possibly expand its business in Europe. The move sent up shares of AT&T almost 2% to $35.22. Crown Castle fell about the same amount to $74.66. And over in the oil patch, the price of crude closed below $100 a barrel today. That's the first time in nearly 4 months. Oil ended the day at $99.22 a barrel, while U.S. crude supplies jumped to a much higher than expected 4 million barrels last week.
Well, one reason why oil prices have been inching lower lately is the boom in domestic oil as the U.S. becomes the world's largest energy producer. And one of this country's biggest oil and natural gas fields can be found in a state that prides itself on doing everything big, Texas. Brian Sullivan joins us now from Midland, just above the Permian shale field, which is fueling an economic boom in the Lone Star State. Good evening, Brian.
Tyler, good evening. It's really incredible here. I mean, in fact, we are pretty much sitting right on top of 50 billion barrels of recoverable oil, making this one of the largest oil fields in the entire world. And, you know, Tyler, we can read about it, we can hear about it, but in order to really understand what's happening here, you got to see it for yourself. So we hopped on a plane and we came out here to West Texas to see what this Permian Midland boom was all about. Two things seem to go on forever in Midland, Texas: the skyline and the number of oil wells. Midland is right at the center of the energy boom that's coming from what's known as the Permian Basin, quickly becoming one of the largest oil and gas producing areas in the world. And in an area known for high school football, the topic of drilling is never far from conversation. Midland native Sean Holcomb played for the New England Patriots. He now works as a landman in the oil industry, figuring out who gets paid for the oil riches under the earth.
They come to me and they say, hey, who do I need to pay? You can own the land, but not necessarily do you own the minerals.
The industry is booming, and so is the town. Midland now has one of the highest per capita incomes of any city in America, and people are coming from all over to get in on it. The job market is so tight that fast food workers can make $12 to even $15 an hour to start and even get a signing bonus. The town's population is soaring, and hotels and housing are popping up almost as fast as oil wells. Paul Green left a high-paying job at a big drilling company to go off on his own. Listen to what he's paying his employees.
My highest paid employee last month, his salary is $4,800 for the month. I paid him $1,000 for his truck allowance, and I paid him $31,000 for his day rate that he was on location.
And it's not just Green's employees that are doing well. Shareholders of companies like Pioneer Natural Resources have also seen their wealth increase. Some fear the boom could end in a bust, like it has before when they were using this type of drilling equipment. But others say no, this time is different because new technologies are enabling us to drill wells more efficiently and smarter. And while things may eventually slow down, right now the only thing flowing faster than the oil and gas seems to be the money. And guys, what's even more amazing is how widespread the boom really is. In fact, this is one of the wealthiest zip codes in America now, 300 miles west of San Antonio, Texas. In fact, the average per capita income here is now higher than that of Silicon Valley. Put that in your cowboy hat and smoke it, Susie.
I wish I had a cowboy hat. Bring one back for me, Brian. Thanks so much, Brian Sullivan.
I will.
Reporting from Midland, Texas. And you can read more about the energy boom in Texas and its economic impact on our website, nbr.com.
And coming up, how the J.P. Morgan settlement could end up costing people hunting for a mortgage. But first, how commodities, treasuries, and currencies perform today.
A top Federal Reserve official thinks the government shutdown will delay the expected start of the Fed's tapering of its stimulus program. With two more central bank meetings left this year, one in October, the other in December, Charles Evans, the president of the Chicago Federal Reserve Bank, expressed doubt that there could be any pullback that soon. And a bit of a setback for existing home sales in September. Sales of previously occupied homes declined almost 2% last month, as rising mortgage rates and higher home prices appear to have kept some would-be buyers on the sidelines. Median home prices in September rose more than 11.5% year over year, but that's the slowest annual gain in the past 5 months.
Well, that tentative $13 billion settlement that J.P. Morgan Chase reached with the federal government includes some payback for burned investors, but the deal may also end up costing some investors and hurting would-be home buyers, too. Diana Olick has our story.
The potential $13 billion deal with J.P. Morgan may appease those who blame the banks for the financial crisis, but it will not help consumers get a mortgage.
The biggest problem is you can't get a mortgage loan today unless you have super credit. And this is just going to make the banks be even more conservative.
Mortgage credit today is exceedingly tight. Borrowers need high credit scores, large down payments, and full documentation. Credit is also more costly. Last spring, the government insurer of low down payment loans, the FHA, raised its premiums and fees, resulting in a 14% drop in new FHA loans to buy a home between May and July.
Credit is so tight overall that 33% of homes purchased in September were paid for all in cash, according to the realtors. That share is usually less than 10%. This as new mortgage rules that could tighten credit even more go into effect the first of next year. Couple those with the settlement, and banks have plenty to fear.
If they're going to go after you for helping the government out in taking over distressed institutions at a time of crisis, then why do you have any confidence that they're not going to go after you for some technical violations of the dozens of new rules that have come down?
The $13 billion settlement reportedly includes $4 billion in consumer relief. Sources close to the matter say details on that are still being hashed out. It would not include direct payments, but could include debt forgiveness to borrowers, something the bank is already doing.
I look at the $4 billion as just another a headline juice. Nothing really, I don't think that's a big number. I don't think there's nothing there, basically. $4 billion soft dollars, probably stuff they already did already.
The result will arguably make the banks more leery to lend, and in today's rocky housing recovery, that does more harm than good. Diana Olick, Nightly Business Report, Washington.
And finally tonight, at least one Floridian looked like he was getting a jump on the holiday shopping season over the weekend, but he wasn't exactly welcomed with open arms. A 6-foot-long alligator showed up at the front doors of a Walmart just outside Orlando on Sunday morning, causing the automatic doors to open and close before employees were able to lock them shut. Local police were called in, but the gator scurried away to some local woods. There were no problems. Ty, look at him just sort of sulking.
He's ambling off. I think he was going to the Pirates of the Caribbean ride at Disney. That was his next stop there. There he goes. Look at him.
Walking pretty fast.
Yeah, he's pretty good, man. I like him.
No shopping bags, though.
No shopping bags. No, sir.
That's Nightly Business Report for us. I'm Susie Garrett. For more on the stories we covered, head to our website, nbr.com.
And I'm Tyler Mathisen. Thanks for joining us tonight, everybody. Have a great evening. We'll see you back here tomorrow.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. President Obama spoke out for the first time about the botched rollout of the administration's online health insurance exchanges 3 weeks ago, vowing to fix the problem. On Wall Street, stocks were little changed after a mix of third-quarter earnings reports and a weak sales outlook from McDonald's. The Dow lost 7 points, the Nasdaq rose 5, and the S&P edged up a fraction to a new all-time closing high. Sales of existing homes declined almost 2% last month as rising mortgage rates and higher home prices appear to have kept some would-be buyers on the sidelines. And the price of crude closed below $100 a barrel today for the first time in nearly 4 months. Be sure to tune into Nightly Business Report right here on your public television station.